We were talking about stocks. The nice thing about that is you can buy and sell them whenever you want. One of the problems with private credit is you can't do that all the time, and that's a problem with Blue Owl Capital. They announced that they will tighten investor liquidity in its retail focused Blue Owl Capital Corporation 2 fund after offloading $600 million worth of portfolio assets. Blue Owl said that following that deal, the fund would end regular quarterly liquidity. How about that? Payments to the fund's investors. Word salad in there. Malcolm, why is this something people should pay attention to?
Yeah, so this is one of the funds that I have been talking about on this show for a while, that I've been worried about because so much of it is focused on building out AI infrastructure. And we are going to build this fund by democratizing access to private markets and allowing retail investors and individual smaller dollar investors to participate for the first time ever, because you guys have been locked out for so long, which, don't let me disparage too much, is true. It is a fact that a lot of the dollars that have been earned and made in the venture capital space, specifically investing in companies like Uber and, Facebook and Google and whatever else, have been made outside of where public market investors have been able to have access, which created a bunch more billionaires and still excluded a lot of the folks that are at the bottom side of that K-shaped economy that we talk about all the time. All that aside, this is not a standalone event. So by Blue Owl saying, basically, this thing that we marketed to you as semi-liquid, and this thing that we told you was going to have quarterly liquidity opportunities, is now saying, we need you to keep your money in this fund because we cannot afford to return it to you at the interval that we promised. And at the same time they're saying that, it's because the market is crumbling as it relates to the AI trade. We just talked about it's been going since October. And so you have a whole bunch of retail investors who are hoping and expecting that they should be able to pull their money back out of this thing as quickly and easily as they did when they sold Microsoft or when they sold Palantir or whatever else they owned. And I don't think that they really fully understood the mechanics of how this thing works. I don't think that the company fully explained enough and loudly enough how this thing really works. But candidly, I think what's really happening here, sitting in the middle of all this, is a lot of ill-informed people who should have known, i.e. the financial advisor that sold it to them. So my concern here is that a lot of the folks who are individual investors getting into these private credit funds are not going out looking for them. They're not calling up Blue Owl and saying, hey, can I get access to that BDC fund that's going to lend money to Meta to build a data center. They're leaning on their financial advisor to put them in the right stuff. And what I'm seeing, I just had a conversation with a buddy of mine over at AssetLink, which is a company that aggregates data for the financial services industry. And one of the things they were pointing out is that there's been this big wave of financial advisors in their 30s and 40s specifically leaving the giant mega banks and going to independent firms, sometimes taking all the clients with them that they were working with at that mega bank. And now there's been this huge uptick where for that cohort specifically, their clients own about 20% of their overall allocation in alternatives, where the old school methodology was about 5% is enough. And so at the average was less than 5% exposure to alternatives, everything else traditional stocks and bonds. And so now in just Q1 of this year alone, still according to their data, there's been more than $600 billion pumped into evergreen private credit funds. And we're seeing financial advisors replacing the traditional public bond allocations in their clients' portfolios with senior secured debt tied to the AI economy. So now I've got people whose public equities, because 30% or so of the S&P 500 is hyperscalers, that's all exposure to AI. Now the 40% that's supposed to go to bonds is going to these BDCs and SPVs and everything else that are financing the AI economy. So now more than half my portfolio is exposed to AI. That is why people are hitting the panic button and trying to pull those dollars out, because the narrative has changed and the party isn't as fun anymore. But it never should have happened in the first place, in my opinion, because if I am a 75-year-old retired nurse who is depending on my portfolio for income in retirement, and I'm looking and seeing the price of everything go up around me and worried about whether I'm going to have more month than money someday, that is not the place where I want to take a risk with the 40% that's supposed to be the boring, slow and steady money, where the only time I really pay attention to this bond fund that I'm in is when they make their quarterly distribution to me and it goes into my IRA or my brokerage account. So this whole thing is starting to show some meaningful cracks, and the people that it's cracking on, the retail investors who are getting into these funds, are the people who can ill afford to have it happen to them. It's not the big Saudi money that piled into a private credit fund that is suddenly saying, hey guys, we need to get that money back. It's not the endowment of Howard University or Columbia or somebody that's saying, hey guys, we need to pull that money back. It's everyday investors who had these things foisted on them that are standing to really lose some meaningful money here, and it didn't need to happen.